What is going on, DeRosa Insiders community? This is Matt Faircloth, and welcome to DeRosa Insiders Live. This is a live program. That's right. This is live. If you guys are watching live, lucky you. We go live on noon. At noon on certain days. Today's Thursday. We used to go live on Fridays. We're going to be moving that around a little bit to catch some of your schedules, catch some of your calendars. So if you guys are over here watching this thing on a Thursday being like, I thought this is Friday. No, you are in luck, my friend. If you guys are watching live, the eyeballs I see on me right now, I see you. I see you. Lucky you. So say hi. If you guys are watching the recording, that's all good. Make sure you like the show and stay tuned for other live broadcasts that we do where you guys can watch the show live, make comments, jump into the conversations, be a part of the convo about real estate investing, about building real estate businesses, just the inside look at real estate investing. DeRosa Insiders is what we do. If you guys want to join an awesome, cool community, go to Facebook and go to DeRosa Insiders, where you guys can join a free, capital F, free community called DeRosa Insiders on Facebook. And hey, we talk about all things real estate, talk a little bit of shop about real estate investing is on there. So check that out too. Guys, I got a phenomenal guest to come to talk to us today about really cash flow and investing and those kinds of things. Not real estate, kind of sort of real estate, but also not real estate. As I understand, it kind of involves real estate, but it also kind of doesn't. So an alternative real estate, an alternative investment you guys can consider. But that's a tease. We're not bringing them on yet. You guys got to sit tight for a second here for us to talk about things going on in the world. So stay tuned for our guest. We've also got our girl Tara to talk about to talk some T Talks multifamily and a means, a undeniable way to effectively find out what your competitors are charging in rents and what they're offering for small and large size rentals in the market. It's called a secret shop. I know, sounds illegal. It's not. So we're going to talk about how to secret shop, and that's going to be coming up in today's episode too. So big episode coming at you guys. Stay tuned. And that. So let's unpack it and get going. Guys, a lot of people are talking about what's going on in the current election, right? And I'm not, listen, the last thing I would ever do is to tell y'all who I think you should vote for, who I'm voting for, or whatever. That's not, I don't think it's my place, right? I actually kind of believe the politics probably gets discussed too often in between friends and public forums or whatever. I think it's more of a personal choice and personal alignment. But people do ask, right? Thank you, Energy. There it is, Captain. So like a little shout out from my Captain America shield, and Captain America is close to my heart, as you guys know. So I gotta give him a shout out there. What do I just throw out, guys, about the politics and about the elections and whatnot? Because people ask, like, hey, what is going to happen to real estate investing going into and short-term, long-term after the election? So here's what I remember from 4 years ago and 4 years before that and 4 years before that, because I've been investing for 20 years, and I can tell you that real estate investing does get affected by the election cycle, but it is something that's not typically the way that you would think, right? As a voter, that there are certain strategies that certain presidential campaigns have brought in, like the Trump administration put in a program that allowed people to do through opportunity zones and things like that, to do tax credits. But before that, other presidential administrations implemented all kinds of other things for real estate investing. Just what you got to do is there's not a one candidate over another you should vote for real estate investing. Just understand what they're going to do that's going to affect the market of real estate investing, right? Yeah, even during COVID, the rules changed, and we got to go to follow along with the rules. So I would suggest that, as I've done, read the campaign platform for both presidents and look to see what they're planning on doing long term, right? And how you, as a real estate investor, can play in with that, right? Because your vote is your vote's your vote, but it's going wherever. Whoever gets elected is going to have their own initiatives that they're going to implement. Teach me the rule. Find the rules. Find out the rules that they're going to do. If they're going to be bringing back the Qualified Opportunity Zone Act or something like that, find a way to make money with that, or not. Or find a way to make money with more affordable housing, or whatever it is that the initiative is going to be. That's the long-term gain. It's short and simple. That's the long-term gain that you want to play. Now, what's going to happen, as I predict going into the election, because it's currently the Democratic administration going in to try and get another Democrat elected, whatever that may be, you're likely going to see some changes, pushes in the stock market that's going to affect the real estate affinity for real estate. such as interest rates and those kinds of things. We're probably going to see an interest rate drop. And if you believe that interest rates are tied to the election, I'm not saying they directly are, but we've been due for an interest rate drop. So I think we're going to be seeing an interest rate drop, whether you think that that's a puppeteer move to try and get the stock market to bounce because of because of an interest rate drop, or whether you think that that is something that's truly going to happen just because we need it, because we're due for it or whatever. Either way, we're going to see it. And so be prepared for that. So if you've got a refinance that's hitting, or a purchase that's going to hit in the next, say, 30 to 45, 60 days, I personally would try and extend any acquisition out a bit, because you're going to be seeing, I think, lower rates in the next 60 days, partly because the election, partly because the Fed's been talking about doing it for a while now, right? That said, there is a certain emotional frenzy that comes around elections. Our country is so darn polarized these days, right? That I would be cautious, aside from interest rates, like I just said. Short term, there is such polarization that happens. So I would be careful about I would be a bit cautious going into the election and just for your plans for a couple months after the election, because just, whoever gets elected, first of all, let's put it this way, 50% of America is going to be not happy. Okay. And that, so regardless of what they do with that, 50% of America is not going to be happy with whoever gets elected president. And I'm not saying who should or should not be elected. That's certainly going to be what happens no matter what. That unhappiness certainly flows into all kinds of things: economic sentiments, jobs, the way just people feel about their day and everything like that. So I just think that things are going, if I were I'm a real estate investor, if I were you, I would be cautious with regards to making bold moves or major changes in your business in the next, say, 3 to 6 months. That's the short-term plan, because just as in my all-time experience, election cycles are weird. They're just weird. They tend to bring out the worst in everybody, And so you're going to see the worst come out in everybody. The worst come out in commentators, the worst come out in the media, the worst come out in people and the way they act, including buyers and sellers and everybody like that. And just people are going to be a little skittish about the election, kind of wanting to see what happens. So I think that the best thing to do is to wait a little bit until you see what happens afterwards. Now, the article that Nabiku, my ghost in the machine here, is going to post, I want you guys to check out. You only get this article if you guys are watching live. That's why you got to watch live, or go to DeRosa Insiders where you can get a copy of this article. So Nabiku, please put it out. The article is really about how election cycles affect local economies, more national economies as well. So read this article because it's a good insight. I just gave you my take on it, but I want you guys to read this because it'll tell you how you guys can play into investing around elections for your current real estate business, and what you should do even on a local side, like who's going to change zoning laws, who's going to affect national scales and things like that. So guys, check out the article that was there about how elections affect real estate. My advice, just be a little cautious and sit tight. And then once the election dust has settled, so to speak, and the emotions go, the emotion factor goes back to normal level for the next 3 years and 9 months, right? Once that happens, then you can go and look to see who got elected and look to see what they're going to be implementing and how you can benefit that in your business. Be more pragmatic about it. Like I said, teach me the rules and I'll play the game, kind of thing. Okay. That's what I got for you guys today with regards to real estate investing and elections. Hey guys, we're going to be talking today with a guest about, not directly about making real estate investments. This is real estate investing is in general an alternative to Wall Street. And we're not the only alternative to Wall Street. There's other things you guys can get into as a passive investment, or even as a syndicator operator putting these things together. You can go and buy a portfolio of ATMs. That's an alternative investment. You can buy into merchant retail investments. You can buy into self-storage. That's a real estate investment, but it's not what we do. There's all kinds of different asset classes for passive investing as an operator that you could aggregate and put together, as an operator that you can do, or as a passive investor that you can enjoy the benefits thereof as a passive investor from those types of investments. Today, we're going to be talking about a passive investment that I'm actually really curious about. I'm excited to have this conversation because I'm not an expert on this. I'm bringing in an expert to talk to you guys today about an asset class that we all use. You guys are probably using it, right? If you get the lights on in your house, you're probably using this investment right now. Okay. And that is the investment of oil and gas. Michael Tanner, oil and gas expert. Welcome to the show. How are you today?
I'm great, Matt. Thanks for having me on, and really great kind of overview of where I think rates are going. I think as we'll get into a lot about oil and gas versus real estate. I mean, rates do affect what goes on in the oil and gas business too. So I really like that
Oh,
overview,
yeah.
and probably tend to agree with you about which way it's going to fall, whether or not, depending on the outcome.
Listen, here's the deal, man. Because what Michael's talking about, I do a segment before this one where I talk a bit about things happening in the current market, and a lot of students that we have and I see in the world, people are like, well, who's going to win the election, and how should I change my investing strategy based on the upcoming election? Newsflash: it doesn't matter who's going to win the election, right? What matters is that what they're going to implement, and just you got to see who's going to get elected, and then change your strategy based thereon. Certainly, I talked about real estate investing, but in your industry of oil and gas, who gets elected president is going to affect everything from the Keystone Pipeline to, one of them's going to keep it going, one of them's going to shut it down, right? And there's all kinds of other things that they're going to do to implement. And I get, this is not a political show. This is not here for you and I to say who ought to win the presidency, because at the end of the day, you and I are just one vote, right?
Yep.
I enjoy the pragmatic look on politics of just listen, vote for who you're going to vote for. But I'm not going to sway an election by a podcast. And so what I'd rather do is I'd rather teach people to say, listen, find out the rules. Find out the rules, but vote with your heart or your wallet or whatever you want to vote for. And then detach yourself emotionally from it and find out who's going to get elected and find the rules that they're going to be playing by. Get a copy of their playbook as soon as you can, and then play the game that they're going to be that they want you to play. That's it.
Yeah, absolutely. And I think, from an oil and gas perspective, there's a pretty hard split, one way or the other. Doesn't take a political genius to figure out where most people in the oil and gas business fall. The funny part is generally the opposite is true from, one of the big drivers of our industry. Everyone goes, well, what's oil prices going to do? And first off, I will not come on here and talk to you about where oil prices were going, because if I knew where they were going, I wouldn't need to be on this show. I'd be out doing something else. So, but generally, when Republicans are in office, they're very favorable to the oil and gas business from a regulation standpoint. We generally see production go up, but that actually corresponds negatively with prices. And you actually see it on the other side of the aisle that if you kind of do a chart of political office versus oil and gas prices, you'll find it inversely correlates with people's actual beliefs. So it's a super interesting dynamic. I completely agree with you. It's why I don't necessarily, I'm with you. I don't necessarily like to dive into the politics of it, but you're absolutely right. Understanding what affects what you're going to do specifically from an asset management standpoint is absolutely critical. So no, I enjoy the breakdown.
Arguing over politics is like arguing over which way the wind's going to blow.
Yep.
Right? It doesn't matter. It's my voice on something that's way larger than me, and that I'm a participant in, but I'm certainly not the controller thereof. Right.
Yep.
So let's start. So thanks for your insights on that. Right. Let's go here. Right. I'll go super basic, right? Mm-hmm. Because this is also benefiting me personally, Michael, right? So what is oil and gas investing, right? You're not like buying gallons of gasoline and trying to resell them from your local Shell station, right? Like as a investor, how are investors able to participate in such a thing?
So there's a lot of different ways to participate in the oil and gas business from an investment standpoint. Traditionally, much like you could go invest in a REIT, you can go invest in an ETF that exposes you to the stock market. We wouldn't necessarily consider that an alternative investment, but that, that's probably for your more, stock focused people.
Yeah.
That's a way to do that. But there's a opportunity there. Then there's what we would call, the very similar to an oil and real estate syndication. You can invest in an oil and gas syndication, which, it structurally is the exact same as how real estate looks. You've got an operator. They have a group of assets. They want to either go buy them, or they've already purchased them and they're cash flowing it and are just, selling out parts of that cash flow underneath it, or they have a plan to go, again, they've purchased an asset and there's a plan to go improve the asset, generally by drilling or completing or reworking new wells within that. We can kind of dive into all of that. And then you have, alongside of that, you have the mineral and royalty side, which is actually probably the most synonymous with real estate and real estate investors. A lot of real estate investors generally, when they dip their toe in the oil and gas space, it's generally through royalties and minerals, because the same structure generally generally applies. You're buying a group. You're actually buying the royalties and the minerals that are associated with it. So, me as an operator, I don't actually own the royalties and the minerals. I lease them from the mineral owner, and the mineral owner is generally somebody who's owned them going back to 1850. In Texas, most surface and land minerals have been separated, so the person who owns the land may not actually own the minerals. But how you got the minerals way back when was just you owned a ranch, and in part of the deed to the land, you had both the surface rights and the mineral rights. So when you go to explore for oil and gas, you actually lease those mineral rights from a mineral owner. They may end up selling them off to another type of syndication fund, which then you can invest in as a real estate investor. But generally what I'm familiar with is kind of that second swath, which is actually buying physical oil and gas assets, whether they're producing or whether we're actually going to go drill for new oil. And then, using that as an upside to continue to see. So it's there's a whole different way. Generally, the oil and gas business is broken down. You've got the upstream where you think of, we're going to go drill a well and produce it. Your job stops after you get the oil out of the ground and a truck comes and picks it up. You've got the midstream side. Well, then they put it in a pipeline. They go and send it to a refinery. And then there's the downstream side where they actually take that product and turn it into what we would call a refined product, or something like jet fuel, or, gasoline that could go in your car, plastics, other products like that.
Yeah, but the downstream, like you're getting into larger and larger corporate entities that are in control of things as you take that oil out of the ground, right?
Yes.
Oil and gas out of the ground. So like the folks that are turning it into, that are taking oil that I took out of the ground and turning it into a piece of plastic, that's like DuPont, right? So you're better off just buying shares of stock in DuPont or ExxonMobil or whatever it may be. Like a average investor is certainly buy a part of a publicly traded company that's doing that. But as you get closer to the source, right, you're more scattered. You're more like the source of the oil and gas is all over the place, right? So when you say the asset that you're producing and investing in, you're talking about like the asset for me is an apartment building that a tenant lives in and is paying us for the joy of having a community to live in, and that's a residence, right? For you, the asset is pretty much a hole in the ground with that's in a well thought out specific location with a pump on it that's got oil and gas coming out, correct?
Absolutely.
Like the asset is the well.
Absolutely. The asset is the well, and really the asset is the production stream that's coming out of the well, because that's what is actually is providing that cash flow from the standpoint, much like the rent coming out of the real estate. I also, if I make a terrible real estate analogy, just call me out. I am not the real estate expert on here. That's you. So if I make an analogy that you don't like, just feel free to call me out. But really it's, yes, the asset is the well, and the income comes from the actual stream that comes out of the well. And, in a lot of cases, a lot of oil and gas investments, there's a little bit of what we would call proven production, where there's already a little bit of oil actually flowing, but you're going to go, if you see right here, you're going to go and a lot of what these, especially what we do is we go get an oil rig, and we're going to go drill a new well because we've proven there's oil right next to it. We're going to go drill a new well, which generally is going to have a little bit more production at the beginning of the time. And you'll see a nice big kind of bump in production, which is going to translate into income. So yeah, your asset is specifically oil and gas wells. And I mean, something that's interesting, I didn't know this when I first got into the business, but you hear about the Exxons, the Chevrons, and all the big companies. You think, wow, they're the only ones that produce oil. There's 90% of the oil and gas that is produced in the United States comes from a company that's producing less than what I would say 1,000 barrels a day, which is not that big of a company. So your backbone of the oil and gas business is your small mom and pop operators like us, specifically. And,
let me unpack that for a second.
So much scattered. There are your big companies out there, but the majority of it is actually these really smaller companies, which I think is super fascinating. It's similar to real estate. You've got your Blackstones, you got your big companies, but there's a lot of really small companies out there that are managing 1, 2, 3 properties. Kind of works the same, I would imagine.
Yeah, no, right. And that's like a misunderstanding in that, like, trying to think of an example, but like Greystar is the largest property management company in the US, right? They probably still only manage a single digit % of the US population of housing, right? And so it's a misunderstanding as well, as I had as too, to think that name the names, right? Chevron, BP, those folks own all of the producers that bring the oil and gas out of the ground, right? That these oil and gas wells are owned sometimes by mom and pop, you
Yep.
know, or sometimes by small syndicates and that. So when you say a producing well, right? You're talking like, is there like a, could you have a hole in the ground that doesn't have? I could probably drill a hole in the ground in my backyard here in Pennsylvania, but I'm not going to get anything out of it, right? So how do you determine the location that you're going to get oil and gas out of, right? Like, why, that's, it seems somewhat speculative, but you guys are getting product out of the hole. So how do you determine where's a good place to drill and where's not?
Well, it's a little bit like you can think of it like a development project from a real
Mm.
estate standpoint.
Mhm.
You could go technically drill a hole anywhere in the ground. You could go build a Walmart anywhere in the country, but if there's nobody around there to go purchase the goods from it, if there's no other producing wells around it, it's probably not a good asset. So really, there's kind of two different ways to look at finding oil. One is what we would call, offset production, which basically means we're in an area that's known to have oil and gas production. There's 15, 20 wells around. If you were to go look at a Google Earth image of Midland, Texas, you would just see little dirt patches within 5 blocks of each other, just boom, 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 spattered all around there. That's because there's just wells all around. We've determined that there's oil there. And the real question in that type of is not, is there oil there? It's, how much are you going to go get? And that's kind of the next part of the equation that we can get into a little bit. But and that's really what we would call proven development, which is oil's been proven to be there. It's more logistical in nature. It's more, hey, what's it going to cost for us to go get this amount of oil out of the ground, and how much oil are we actually going to get? Because you can imagine you can get a lot of oil, but if it costs you $100 million to go get it, it's not profitable. The big thing in oil and gas is, can we economically produce this oil? We know where a lot of oil is in the country. It just may take $300 oil to go get it. I'm not saying oil is going to go up to $300, but it's more a matter of economically being able to produce that asset. Then you can also get into exploratory type drilling, and that generally doesn't fall within the syndication and the oil and gas syndication market because it's highly speculative.
Who's doing that? Who's doing like that? Who's gonna, like? There's got to be somebody that's out there saying like, "Hey, I believe."
Your big companies, your big companies, Exxon Mobil's, your big independents who have the ability to go drill a $15 million well and produce nothing
and get nothing out of it.
Yeah, but
that would bankrupt you and me. But for them,
I've worked in large organizations, and there's something to be said about, hey, this well didn't produce anything, but we got a lot of science off of it. And to me and you, $15 million for science is, we wouldn't want to do that. But for these larger companies, the Exxons, the Chevrons, Pioneer just got recently acquired by Exxon, but they were generally thrown in there. EOGs of the world, their capital expenditure budgets are billions of dollars a year. They're willing to take a much bigger risk than me and you are willing to take in order to acquire some science. I mean, the biggest oil and gas field that's producing right now offshore is down in Guyana. There was a Wall Street Journal article about 2 months ago that I'll see if I can get somebody to drop in the chat, but they spent $75 million to explore that before they even knew there was oil and gas there. Now, it's turned into probably one of the largest offshore oil and gas finds, and is the main reason why Chevron is trying to buy Hess. There's all this stuff going on in there that we don't need to get into, but the appetite for exploration generally rises to those larger and larger companies. And then as they explore, and it's kind of like venture capital, you only need one of your 20 exploration wells to hit, and you've made your 50x return on that. And then everything kind of moves down the chain, and your smaller oil and gas companies generally are more on the development side, where they're going into a field that's proven. They're going to come in and figure out how to cost effectively produce oil and make sure that it continues, to produce for 15, 20, 30 years.
Why doesn't Chevron do that? Like, if Chevron taps a well,
they do
in the middle of some spot in Texas or whatever, because it's, most syndications that you're doing are based, or there are some overseas as well.
What we do specifically is all onshore U.S. We operate right here in North Texas. I'm sitting in Dallas right now. And it's not that Exxon and Chevron don't do that, but their appetite to do exploratory type ventures is a lot higher, because then if it pays out, they have the capital to go then spend. I mean, this Guyana asset I just mentioned is going to need $10 billion of investment over the next 5 years to develop. So even if me and you went and found all that, we'd be back at the drawing board trying to figure out how to raise that capital.
How to get it out
of there. If we had that, we could, but it's just a matter of, coming down to, again, the economics of where the oil is, how much it's going to cost to get out of the ground, and then the appetite for somebody to go in. And offshore is a completely different ball game relative to onshore production. And there's limited access in term, if you are interested in offshore oil and gas, you can just go buy. I can give you 4 or 5 different stocks that are specifically offshore oil and gas operators that you can expose yourself to more. But generally, for the onshore U.S. oil and gas syndications, it's all onshore.
Yeah, no, I get it. Okay, so for you, what you're doing is you're identifying wells that are already in proven locations, right?
Mm-hmm.
So that means when you say proven location, does that means that you've got a producing well here within sight line of the well that you're going to drill? So it's like, hey, I'm going to put one next to this one that's 100 yards down the road or whatever it is, because I know that there's a ginormous pool of oil underneath this because it's producing. So I'm going to put one here that's also producing as well. That am I saying the strategy correctly?
Yep, absolutely.
Okay.
And there's a little bit of geology that goes into it because it's not 100% certain that if you drill a well 100 yards away, you're going to actually, strike oil. It's a good chance. You can kind of think about, if you're looking at it from kind of like, we call it a cross-section view, there's basically a pool of oil down there, but that pool has boundaries. One of the big reasons, you've heard, if you've heard the term shale oil and gas or unconventional oil and gas production, that was really unlocked by the fracking revolution in the mid 2000s, because they were able to basically unlock these shale plays, which are, you can think of almost like a blanket thrown out over of the floor. And if you stack all these blankets up and you have oil in those blankets, well, now you're no longer have a pool of oil. You have a massive blanket that you can go and attack. And it goes back to, it's not that we don't know there's oil there. It's how do we get the oil out of ground? But these shale oil plays, the reason the oil doesn't move freely, a lot of the conventional fields that we go after are what we would call, as I just said, conventional oil and gas, which means it's a pool of reservoir. All you need to do is stick a pump jack on it, pump it up and down, and the oil will come out. What these shale wells do is not to get too technical, but the permeability is so tight, which means the oil doesn't naturally flow within the reservoir, that you have to go frack the wells, which is basically creating, in a dumbed down version, creating highways for the oil to move and then produce up the wellbore. Usually you'll stick a pump down there, and now that you've initiated flow by fracking, all of the oil or gas will be able to come up. So that there's kind
you're
of
pretty much putting a bomb down there, right? Like you're putting you're doing a small micro explosion, not like a nuclear bomb, but like a little bit to break out some of those pathways so that where things can flow freely and everything like that. Yeah, no, it makes sense. Okay, so once you've got a producing well and the oil's flowing from it, and you're syndicating, when you run a syndication for these things, typically, is it one of these wells that is going into the syndication, or is it like a whole, dozens and dozens of them, hundreds of them, thousands of them, or just a handful?
It's going to be a mix of both. So you're going to have multiple producing wells within the syndication. So you're going to say, we have this field, there's 40 wells that are already producing oil and gas. What we're going to do is we're going to layer on top of that 5 new drills that we're going to go drill. And those wells are going to add X amount of production to the amount of production that's already there. So there's that upside case. So you're not just buying what generally is just a normal producing asset. There's where the upside comes into that. And usually it's a group of assets. We do it a little bit differently than a straight syndication. We actually make you and are offering direct underlying working interest, which that's a oil and gas technical term, but that means you are physically buying a piece of the well. You're not buying a piece in a partnership that's then going out and buying wells. You're actually physically buying the underlying asset itself, which means you own it, which means you can do whatever you want with it at the end of the day. If you want to sell it on your own and find somebody who wants to buy, prices go up heavily and somebody wants to buy your 3% interest in these 40 wells at a price that you really like, is couple times more than you paid for it, you feel like it's worth more than the future cash flows, you can sell that as often as you'd like. We like to do a first right of refusal, just because if you're going to sell it, we won't like an opportunity to purchase it. But you actually physically own the underlying asset itself, not just an interest in a partnership that then will go out and buy individual assets itself, which in our opinion gives you a little bit more control as an investor, because you actually own that underlying asset itself. And the second thing that allows is massive tax deductions. And that's really the big, for everyone out there listening in real estate right now, the real main benefit of investing in oil and gas and doing it via direct working interest is the massive tax deductions associated with that. The U.S. tax code, and I'm first to say I'm not a CPA or a tax guy, but the U.S., and I'm happy to send more information on this, and definitely consult with your CPA. But I forget the exact section, but the intangible drilling and intangible completion costs, which basically means if we go drill a well, 100% of those costs can flow back and can be written off as an investor. So let's say, for example, you invest $100,000 in an oil and gas project, and 85,000 of your dollars goes directly into drilling and completing a new well. Well, you can take that $85,000, multiply it by your federal tax rate, and you can directly write that off at the end of the year. And we generally see at the end of the year a huge amount of interest, mostly from people who are like, wait a second, I've got a $60,000 tax problem I got to figure out how to solve. Oil and gas provides a perfect opportunity to recapture a lot of those, really recapture what the government's going to be taking from you anyway, and can provide a cash flow stream on the other side of it, which is kind of that dual end. But tax deductions are one of the key benefits of oil and gas investing via the direct working interest, as we would call it.
Okay, so you're getting the tax write-off because you're, if the dollars are going into creating a new well, that's a, call it like a capital improvement, like a new investment, so to speak, right? So that's where the tax write-offs are coming from. Cash flow is coming from, selling the product as it comes out of the hole in the ground, right? What is you had mentioned about the exit on individual investors selling? Is that like, if I'm in a syndication of 15 other investors that an operator like you puts together, each individual investor are able to sell their shares individually? Is that what you referred to?
Yep,
Did I
absolutely.
Hear that right? Okay.
Because there are syndication options in the oil and gas space. The way we've kind of shifted the model slightly, it practically works the same as a syndication, but technically you're not actually investing in a partnership that then is going out and investing in the individuals. Your name is on the title for those oil and gas wells, which means you own it, which means you have the ability to go sell those shares whenever you want. So while we don't market to our partners or prospective partners that we're going to sell the asset ourselves, we like to say we're going to hold the asset for the life of it. You do have the ability to exit yourself if you do find somebody interested in that. Now, obviously, you got to find somebody who wants to buy oil and gas. It's not just, hey, you can go out and buy it tomorrow, but there are plenty of, what I would call eBay for oil and gas sites where you could go list these assets on there, and there's a robust market to go trade that. I'm happy to provide more information on it, but I get it. That's kind of the little, what I would call the little difference that we take from a syndication. Practically, it's the same thing, but technically you actually own that underlying interest, which means it's yours and you could do with it what you want. Yeah,
it's as if like a fractional deeded interest in a piece of real estate or something like that, or like a tenant in common, I guess. Okay, is that the only exit? Or as the operator, my thought is that you probably also designed in an exit that's maybe further down the road. It's good to know that investors can, under their own desires, exit whenever they like to. But you probably, as the operator, probably have an exit down the road. What is the exit? Selling the well and its production, or is the exit like pumping the well till proverbially the well runs dry? And you just cash flow it out, and you've gotten so much cash flow during the life cycle of the investment that you've gotten your money back and then some. Like what's the exit look like?
So the answer could be both. When we present prospective financials to prospective investors, we model out option 2 that you talked about, which is we're going to hold the asset through the life of the well, and when the well dies out, it's going to die out. But over the life of that well, you're going to have seen a multiple on the cash flow, even on a discounted basis. The nice part about oil and gas is you get a lot of your money back quickly. Generally, things decline a little bit. So, your future forecasted cash flows can generally be lower than what you get right away, but you get a lot of your money back relatively quickly. We do exit by selling our assets somewhat, but what we tell prospective investors, when you look at our deck and you see our projected financials, we will not execute a transaction unless the deal that is presented to us meets or beats that current projected multiple that we already have just on the cash flows. And that can change because oil prices go up a little bit. And now all of a sudden, our management case is $60 oil. Oil's sitting at $75, $80 oil right now. We project all of our economics at $60 oil. Well, if oil goes up to 85, 90, well, now all of a sudden the upside for those future cash flows are a lot more than what the underlying, projected returns are. And there may be somebody to come in and buy. The other side of that case is you don't actually have to sell because we don't actually own your interest. You own the interest. You can group with us and sell as a whole. That's no problem. But you, at the end of the day, own your underlying interest, which is really cool. So we don't model in an exit, mainly because exits in oil and gas, in my experience, are extremely hard to model because, like I said, I don't know where oil prices are going. I don't know really, truly what the production stream is going to be 5 years from now. I have a really good idea of what my current producing asset will be, but on these new drills, I'm much more confident in the early life production than I am in the 5, 10, 15 year down the road future production. So if I'm coming in and telling you in 10 years I'm going to sell, in my experience, you're pulling that number a little bit out of thin air. And I would be, in my opinion, be a little wary of someone just slapping a fat exit multiple on a project because the market is so robust and changes so often that really, in our opinion, the best way to model financially these assets out is say, we're just going to hold them until these wells stop producing oil. And if somewhere along the road, somebody comes along and offers us a sweet deal, we'll execute upon it and we'll give you an option to participate in that. Or if you like the income that's coming off these wells, you're more than welcome to keep it. And we'll sell our share. Because the other thing that we do that I think makes us a little bit different than a syndication is we invest and we still own a majority of the underlying working interest in all these projects. So in the current project that we're talking about right now, we retain 70% of the working interest, which means 70% of the capital that gets spent actually comes from us. We're only selling about 30% of the underlying working interest, which means, one, I think the incentives are aligned a lot better than a traditional syndication where we're just trying to take a management fee and we're trying to take 10%, off, from a GP standpoint. We actually,
I know what you're talking about. Yeah. I mean,
yes.
it's a lot of time it's more common in real estate to see a GP, walk in with nothing but a smile and a pen to closing of their own money. Right. So they just aggregate a bunch of investors' money and go to closing. Right. Not necessarily what we do all the time at DeRosa, but I get it. And that's what a lot of folks are doing. So just to unpack a few different things that you said here, just to highlight for our listeners here, that when you're looking at an investment for oil and gas, is it fair to say that you're looking at a payback period to say, okay, well, we know the future is somewhat uncertain, but what I can tell you is this well is producing, oil's coming out of the ground and so is gas. And so in a period of, let's say 2, 3, 4 years, you, Mr. and Mrs. Investor, will have all your money back. And then everything we get beyond that is gravy. Is that a way to look at it?
Absolutely.
Okay.
I'm happy to send anybody our deck who's interested. We'll put a kind of a link to go sign up for that. But I think right now we have a 34, 35 month payback estimation on the current project that we're doing. And the nice part is we've already got production coming out of that. So the moment you invest, 60 days later, you're going to start getting a production check. Generally in the oil and gas business, everything runs about 60-day lag because, vendors don't turn their invoices in on time. It takes 30 days for the purchaser to send you a check. So we operate. So basically the moment you invest, there's a 60-day lag. Then every month you'll start seeing production checks, but that comes from, the two, kind of trailing 2 months behind. So absolutely. That's how it works.
So that's a
Or
good thing to look at, right? So if you're
yes.
investing, the big thing to look at is how quick am I getting my initial investment
Mhm,
back? Because I'm kind of like riding into the great unknown on
mhm,
how long this oil is going to be coming out of the well, what oil prices are going to be years down the road. Because like I
mhm.
said, my crystal ball is broken. I have no idea where oil is going to be at 3 to 4 years from now from our initial conversations, everything we talked about from elections and what happens overseas and all this other kind of stuff, right? So those are all that's interesting to know. So let's go one more direction here before we wrap up. I want to like underscore what somebody listening here should be leery of. That I've heard you say if they're looking at a syndication, not one of yours, but somebody else putting it on the oil and gas syndication. It sounds like there's others out there that you were polite enough to not, say specifically what they're doing, but it sounds like what they're doing is they're on there saying like, hey, 5 years from now, y'all, oil is going to be $200 a barrel. And so we're relying, really what they're saying is we're relying on inflation and markets going up to create great cash flow for you. So we're going to exit and sell this well when we're at $200 a barrel.
Mhm.
And that's what's going to happen. And we're also guaranteeing or projecting that this well we just drilled for you is going to produce product at today's rates for the next 15 years, right? So those are things that people should be leery of, just people trying to predict what's going to happen in the future, where in this investment, it seems like it's very hard to do to look beyond a couple of years from now. Is that correct?
Yeah, absolutely. I think the from my experience, I think the things to be wary of is what are you actually investing in? As I mentioned, if here at Pecos and what we do, you're investing in a project where I can show you the wells, we can take you to the field, you can go look these wells up online and actually verify the production through the state of Texas, because every oil and gas well every month is required to submit their production to the state for regulatory standpoint. So we've had prospective investors actually go look up the production, be like, oh wow, I can actually see that this well is producing what you say it is. That's awesome. I don't have to just believe you. So, and that goes into, there are these, the traditional, what I would call syndications. A lot of times they say, hey, we have an idea that we're going to go buy X, Y, and Z property. They don't have to actually go buy X, Y, and Z property, which may be great, because maybe X, Y, and Z property, as they go through the due diligence, as they work down that timeline, may not actually be a good asset. So it gives them the flexibility to pull out, but that requires you to not just analyze. There's no asset to analyze. What you're analyzing is, do I feel like this operator or this syndicator is smart enough to select great projects? And so if you're talking to an oil and gas operator or a syndicator who doesn't have much of a track record, how do I know that they're good? How do I know they're really good at selecting good assets? I'm not, I'm basically analyzing who's analyzing the deals, not able to actually analyze a deal that they have put in front of us. So that's kind of the big thing, is actually understanding exactly what the game plan is. At the end of the day, they all look and sound the same, but trying to just figure out exactly what you're actually underlying purchasing in. Again, also, your traditional oil and gas syndications aren't liquid, which means if you invest $100,000, they don't, they've got it.
That's it. You're
the
in.
exit is only coming from the cash flow they'll give you, the tax deductions that you'll get, or their eventual exit, but you don't have control over that exit. Where in a direct working interest model, you have control over your own exit because you actually own the underlying physical asset. You've still gotten the tax write-offs and you still get the cash flow, and you actually can evaluate the project. Now, the thing to be wary about that is, do I like this project or not? And that can lead in a whole other conversation. It's one of the big things we do, is we do a lot of education around oil and gas and how to actually value these properties. I love talking about all this stuff. So I'm very happy to jump on with anybody and talk kind of the nitty gritty stuff of it. But from an education standpoint, it's understanding exactly what you're investing in to make a decision on, hey, do I trust this management team to make good deals? Maybe I do. And then great, there's a lot of great options out there. Or I actually really like this project and I want to get involved in this specific project. Then there are definitely opportunities like that, which we kind of fall into that category.
Yeah. So all really interesting conversations today. What I want to just underscore is like, just as an investor, you got to do your due diligence. You can't just passively give dollars to people, either whether that be my company, your company, or somebody else's company, or whatever. There's a lot of due diligence that needs to happen, and education that a passive investor needs to take on to consider being a part of some of the things that folks are building, right? So if people want to get educated more, or just are curious enough to hear more about oil and gas, or want to get educated specifically, or even consider doing a passive investment with you guys, how do people get a hold of you and your company? And tell us a little bit about that, and then we can and then we can allow them the space to reach out.
Absolutely. So you can check us out at trevinoresources.com. We also have an energy news website called energynewsbeat.com, which is basically just an oil and gas and energy news website where we have all of the latest and greatest oil and gas news there. We have a lot of resources on there. I'll go ahead and drop a link in the chat here if you want to reach out specifically and talk more about due diligence. But we have a lot of great resources on there. We own our own operating company, which means that when you invest, Trevino Resources is kind of the brand name, but Pecos Country Operating is our actual operating company. We have a lot of great stuff on there. So a lot of different ways to check us out. I'll drop some of the stuff in the comments here, but yeah, again, due diligence is critical. And we focus a lot on education and making sure people do that. It's one of the things I love about you guys. You guys have a great community, and you guys focus a lot on that on your masterminds and all that. So we're cut from the same cloth when it comes.
Well, I want to acknowledge that you guys have a YouTube channel, and that's something that's free for somebody to watch. You watch a 10-second commercial, hit the skip button, and then off we go. Right. So you guys can go to Energy News Beat on YouTube to hear Michael talk all about oil and gas, and there's, I'm sure, plenty of ways to connect with you guys there off the YouTube channel as well. Get educated, guys. This is really oil and gas may not be for everybody. Real estate investing is not for everyone. And that, but it's really about understanding what the opportunity is, making sure it aligns with your goals, and then taking action from there.
Absolutely. No, I completely agree.
Check. Oh, shit.
No worries. Matt, I just really appreciate you bringing me on. And this was fun. Again, if anybody has any questions and want to get a hold of me, we just dropped the links below there. Investinoil.energynewsbeat.com is the best way to kind of find out more about our specific project. Connect with me on LinkedIn. I just love talking oil and gas, so you can ping me with any specific questions that you want. I'm happy to talk, and just really appreciate Matt and your team's time and letting me come on and setting this all up. So it was awesome.
Absolutely. Thank you so much for your insight. It's really good about learning about different places to invest, because that's what this is really all about. It's really all about building our wealth and doing great things, with our money, and doing things that kind of help build our long-term wealth goals and get us there. Right. So thank you for joining us on the show. I'm going to go ahead and drop you down in the green room, and I'll see you in a second. All right. Cool. Thanks, Michael. Guys, great conversation. This is really my takeaway is that it's really all about getting educated for yourself. So you guys need to learn all about the different asset classes that are out there. Be super curious. Be as curious as a 7-year-old when it comes to investing. Find out all the different things. Ask lots of questions. Michael is certainly a wealth of information when it comes to oil and gas. So I highly recommend you guys go and check out his company and watch his YouTube channel. Consume some free information, guys. About this industry, and Michael's certainly a resource that you guys could go to hear more about oil and gas investing. So, guys, transitioning to a conversation about the ways, if you guys are buying an apartment building or buying any kind of rental, how do you know? I mean, you could certainly look online to see what market rents are. But what if there's an apartment building right across the street from an asset you're buying, or down the road that is certainly a good comp? It's the same build, around the same vintage, around the same location, whatever. You don't want to just look online and see what their rents are, because they might say they're taking $1,000 a month in rent, but maybe they're doing a discount for $800 a month. Maybe they're doing a major concession that you need to know about, so you can determine what you can really project to be making of revenue on the asset that you're buying. The way that you do that is through a method called a secret shop. Okay, and we're going to let the secret out. We're going to tell you all the secret today. So listen up. Our girl T Talks Multifamily is going to tell us all about secret shopping. Take it away, Tara.
Hey everybody, it's Tara Smiley with DeRosa Group and DeRosa Living. So our asset manager tip of the day is a secret shop. Why do it and how do I use it, right? So to start with, a secret shop is when you independently as an asset manager or owner, or in coordination with a PM company that you may have, you secretly pretend to be somebody else, where you hire someone to pretend to be a prospect, and they visit your asset, they take a tour, they meet with any site staff that are there, they walk through the property, they are getting a tour as a prospect. So they're getting the sales pitch, and then they're touring the community and touring that specific apartment or unit as a potential resident. So they're evaluating the sales pitch, the speech, the tour path, what the general curb appeal is. They're also evaluating, that specific apartment unit's general appeal. What kind of turn product you have. Is it, well done? Is it cheaply done and kind of shoddily done? Would they, as a human being, want to live there, right? They'll be evaluating the site team's just general customer service level, and do they use the prospect's name? Do they respond appropriately to some of the typical fair housing questions that are kind of red flashy light alarms for anybody in property management, like, is it safe to live here? Or what kind of people live in the community? And those are like red alarm questions that in the PM world, we answer in a very kind of static, professional, kind of canned approach. So is it safe to live here? Well, nobody can guarantee safety, but we would really encourage you to reach out to the local police precinct, and they can give you stats on the area. What kind of people live here? Well, the answer to that is that anybody that's qualified to live here can live here, because we're an equal housing opportunity provider, okay? So those type of questions are typically asked to kind of trip up or see how candid, how professional the site team can be in a secret shop. So that's what a secret shop is. How do you do it? Well, if your team knows you, I wouldn't suggest that you kind of try to go incognito and pretend to be somebody that you're not. You hire a secret shop company, or in all honesty, pay a friend $100 to go and spend 20 minutes with your team and give you an honest evaluation. If you do it kind of solo and rogue on your own, please have a Q&A template. And there are a ton of free samples that are out there. There are websites like multifamilyinsiders.com that'll give you a secret shop template that, your person or friend can fill out for you. If you utilize a company, they usually have that template that they'll provide to you. They may even be able to provide you a recording of the phone call or examples of the response emails they get. All right. Why do we do secret shops? Well, we know as owners and asset managers what we have in our mind's eye for what this community, what this asset is, and what it should look like and how it should be. But sometimes, as on the ownership side, we may not be completely in line with what the market demographic of your potential renter is going to be. And so you would want to send somebody that can get a fresh set of eyes on your asset, on your community, on the sales pitch and general leasing process to see, what their human being response is. Honestly, you're just looking for honest feedback, okay? Because you're going to be biased. Your PM company is going to be biased, right? And so if you have somebody that can go in there and accurately, candidly record, this was great, I loved this part could use some work, this part was horrible, the product wasn't ready, I was shown an apartment that wasn't even turned. You want to get that kind of honest feedback. All right, last thing, how do we use this? Well, there are two frames of thought, and I'll give you my personal answer too. Frame of thought number one is that you use this as a got you moment for your site team, your PM team, whatever. It can be viewed as an accountability measure. There's the carrot and the stick theory to this. That's the stick. The carrot aspect of it is that you can also use it as a training tool, okay? Your site team is going to be much more responsive if they're not afraid of it. And they are able to take it, see where they aced it, see where they did really well, and see where they've got room for growth. That's my personal preference for how to use a secret shop, okay? If you are going to secretly shop your PM company, and you don't tell them about it ahead of time, please understand that most property management companies are going to get their feathers ruffled a little bit, and understandably so. Okay? And it will go over a lot more smoothly if you use it in the carrot mentality of a training tool. Because as much as you are providing them with critical feedback and valuable feedback to reinforce the things that they're doing that are amazing, and to help improve their efforts for things that they need to, pick up and do a little bit better on, it's also a fantastic tool for you as an owner and feedback for you to reinforce, okay, I got it right. This makes sense. This hits the mark with our target demographic, or it doesn't. And that new signage and the color program that I thought I was going to put into this apartment kind of falls flat. And so, again, for yourself, remember, this is a training item if used best, in my opinion. So if you like the tips and tricks about asset management and property management and what to do with, all these tools and these fantastic suggestions, then follow us at DeRosa Group. So you can join our insiders group on Facebook, and you can catch us on social media. And if you really like us and want to learn more, reach out to us. We've got a couple programs that can help you. Talk to you soon.
Good stuff as always, guys. Really lots of great tips on how to really just determine, what the market is, and really just boots on the ground determining market rents for properties and everything like that through the secret shop method. Lots of other great, really applicable tips coming at you guys through T-Talks Multifamily that we'll be broadcasting here on the show on the Cash Flow on DeRosa Insiders Live. In that. So super excited to have more tips coming at you guys very soon. Folks, that has been the DeRosa Insiders Live program. I really appreciate you guys for watching us live. If you guys are doing that, if you're watching the recording, that's all good. Appreciate you guys doing that too. Go to Facebook and join the DeRosa Insiders community now. I command you, do it now. And I really hope you guys enjoyed today's program, talking all about oil and gas, talking about the presidential election, and also localized elections in your local communities and how it affects real estate investing. Check out the article that we posted there on that. And like I said, Tara is laying the smackdown on asset management knowledge today on Secret Shops. Great program today. Really grateful to have you guys watching, and I hope you guys can check us out next week. Take care, guys.